Usually, like when you bring a product to market, the rules of supply and demand are pretty straightforward. I mean, if you have the exact product everyone is desperate for, and you're the one successfully making it right now, you get to charge top dollar.
Right. It's like gravity. High demand plus limited supply means the price goes up.
Exactly. But you step into the world of uranium right now, and suddenly those basic laws of economics just look completely broken.
Welcome to another deep dive. Today we are tearing into the Uranium Unleashed midweek review.
Yeah, we're looking at the data from Monday to Wednesday of this week, so August 12th, 2026.
Right, because the physical reality of the energy market right now is, well, it's trapped in this massive mind-bending puzzle.
It really is. And the defining metric of this entire puzzle can basically be boiled down to one huge price gap.
Oh, the $19.65 gap.
Exactly. We have the biggest, fastest growing uranium producer in the U.S. actively selling its product for $66.85 a pound. But at the exact same moment, the open spot market is sitting there willing to pay over $86.90.
Which is just wild. It's the absolute definition of a structural pricing anomaly.
And that $20 gap is where literally billions of dollars are moving just beneath the surface. So our mission for you listening today is to unpack why that gap exists, decode the two major earnings reports that just dropped, and, really understand what this means for the whole global scramble for energy security.
Yeah, because we are looking at a collision between the physical reality of mining, the very slow, invisible hand of government bureaucracy.
That's slow.
Right. And a global supply squeeze that is making utility companies extremely nervous.
So let's start with the dirt. I mean, to understand why the pricing is broken, we first need to establish what is actually happening on the ground in the U.S. Energy released their Q2 2026 results on Monday, and the operational story there is, honestly, it's unambiguously strong.
Oh, yeah. The physical execution is accelerating way faster than expected. I mean, the company processed 140,873 pounds of uranium.
And specifically U₃O₈, right?
Right, U₃O₈. And that's a 47.4% increase from just the first quarter of this year. Yeah, and up almost 26% year on year.
So that is the fastest ramp-up pace we've seen since, 2022?
Easily. And a massive driver of that growth is their Shirley Basin operation over in Wyoming.
Which is officially online now.
Yes, fully online, got full production authorization, and it's already contributing over 10,000 pounds in just its first partial quarter. And overall, the company shipped nearly 150,000 pounds to the conversion facility.
Okay, so the domestic supply build in the U.S. is very real, and it's on schedule. But here's the detail that really stands out to me. Management is calling Uranium the largest and fastest growing ISR producer in the United States.
Right.
And for those of us who, are used to seeing pictures of giant open pit mines with the massive dump trucks, we should probably clarify what ISR actually means, because it explains their crazy low costs.
Yeah, so ISR stands for in situ recovery. Instead of digging a massive hole, blasting rock, and hauling all that ore to a mill, an ISR operation uses a series of injection and recovery wells.
So it's mostly underground.
Exactly. They pump a water-based solution down into the ore body underground. And this solution just dissolves the uranium while it's still sitting in the ground.
Oh, interesting.
Then they just pump that uranium-rich water back up to the surface to be processed.
So it is basically water chemistry rather than earth moving.
Which fundamentally changes the economics of the entire mine. I mean, you're not maintaining a massive fleet of heavy machinery. You're not processing tons of waste rock. And because of this method, our energy is pulling off an incredible cash cost per pound of just $40.20.
$40.20, that's incredibly efficient. Operations are humming, the environmental footprint is smaller, costs are low. But here is the paradox.
The price gap.
Yeah. Their average realized selling price was only $66.85. Meanwhile, a competitor like Cameco realized over $93 in Q2, and the spot market is hovering near $87.
Yeah, it's rough.
I mean, this feels like a farmer growing the absolute most in-demand organic apples, ramping up their farm's production flawlessly, pulling in this record harvest, but then being forced to sell those apples to the grocery store at 2019 wholesale prices, while the store charges the customer a premium retail price.
That's a great way to put it.
So why are they trapped at this price? How does an operating mine miss out on a $20 market premium?
Well, the culprit isn't a failure in production. It is a collision between legacy contract structures and a totally incomplete policy environment.
Okay, unpack that.
So the uranium market relies super heavily on long-term contracts, to ensure stability for both the miners and the utility companies that are running nuclear power plants. The $66.85 that Ur-Energy realized, that just reflects older contracts written way before the current supply squeeze became critical.
So they are locked into prices agreed upon in just a completely different era of the market.
Exactly. But the mechanism that was supposed to bridge that gap and adjust those prices to the current reality is government policy, specifically Section 232.
Ah, right.
Back in January 2026, Section 232 established this framework for domestic preference and tariffs on imported uranium. The whole intent was to build a commercial premium for domestic supply.
Right, the government threw a press conference and basically said, buy American.
Yeah, but here's the problem. The architecture for domestic premium was built, but the actual, legally binding load-bearing walls haven't been installed yet.
Meaning what, exactly?
Well, the policy established the idea of a domestic preference, but it hasn't established the domestic content threshold.
Okay, let's break down that bureaucratic jargon because this is exactly where that $19.65 gap between the realized price and the spot market lives. A domestic content threshold is basically the exact percentage, right?
Exactly.
So until utilities are legally required by a published government mandate to source a defined specific percentage of their uranium from U.S. producers, there's no commercial mechanism forcing them to pay a premium. Like, the framework says buy American, but without the threshold, it doesn't say you must buy 20% or 30% of your fuel from this specific American mine.
Right. And without that strict, quantified threshold officially published in the Federal Register, utility companies are under zero legal obligation to alter their current procurement strategies.
Oh, I see.
Yeah, they have teams of lawyers and procurement officers whose sole job is to keep fuel costs down for their ratepayers.
Wait. So if the policy architecture is public and everyone knows the intent of the law, but just because the actual bureaucratic paperwork hasn't finished routing through the Federal Register, utilities are just sitting on their hands. Like, are they just exploiting the bureaucratic lag time until the legal hammer drops?
I mean, yes,
Yep.
but acting within the bounds of existing law to minimize costs is exactly what a rational utility company should do.
I guess that's true.
Why would they voluntarily pay $86 or $93 a pound today to a domestic producer if the law doesn't strictly force them to yet? Especially when they can still rely on cheaper legacy contract structures or international spot blending.
It's like knowing the speed limit is going to drop to 35 next month, but until the new sign is actually bolted to the pole, you're going to keep driving 55 because you legally can.
Perfect analogy.
Yeah.
And Ur-Energy's earnings call on Tuesday, they took this exact dynamic and put it squarely in the public record.
It called it out.
They did. They didn't hide the $19.65 foregone premium. They quantified it right there for the policy officials in Washington to see.
Basically saying, look at the money we are leaving on the table.
Exactly. They established that their production ramp is fully intact heading into the second half of 2026. The uranium is physically there, but the contract pricing ramp now requires Section 232 to move from just a conceptual framework to an actually enforced threshold.
Wow. Okay, so if U.S. utilities are being incredibly cheap with U.S. producers today, exploiting every inch of that policy delay, you might think they just aren't spending money at all.
But they are.
Yeah, our sources show they are throwing cash around like crazy, just in a completely different direction. We have this fascinating contrast between an operating mine in Wyoming selling below spot and a development stage mine in Canada that is somehow getting premium market prices.
Yeah, NextGen Energy and their U₃O₈ project up in Canada's Athabasca Basin, they released their Q2 update on Tuesday, and it provides just the perfect counterpoint to the U.S. domestic situation.
I was looking through the numbers coming out of Canada, and the scale is staggering. Let's paint the picture of what is happening at U₃O₈. NextGen has massive liquidity, $970 million sitting on the balance sheet.
Huge war chest.
Yeah. They are executing perfectly on budget against a $2.2 billion estimate. Physically, they have a 3,000-foot airstrip that was just commissioned on site. Diffuser installation began this August, and they've got a 300-person workforce living in the camp. But here is the commercial detail that just feels like a glitch in the matrix to me. NextGen has contracted 11.3 million pounds of uranium to U.S. utilities at market prices.
And the key context for that 11.3 million pounds is that NextGen will not produce a single ounce of actual uranium until 2030 at the absolute earliest.
Right. This is where it gets really weird. You're telling me utilities won't pay market price for uranium pulled out of the dirt in Wyoming today, but they will gladly sign binding contracts at market prices for uranium that is currently locked under bedrock in Saskatchewan and won't even see the light of day for 4 more years.
It's crazy.
Mhm.
but it revealed a massive shift in how utilities are evaluating risk right now.
How so?
The utility looking at Wyoming today, they're playing a short-term policy arbitrage game, right? Trying to save a few dollars while the Federal Register process grinds along. But the utility looking at Saskatchewan for 2030, they're looking at a terrifying, existential global supply squeeze.
Okay, so what exactly is happening in 2030 that has these procurement officers in such panic?
So three massive geopolitical and structural factors are converging basically all at once. First, India's NTPC, which is their state-owned power company, is currently in the active evaluation shortlist phase for a sovereign procurement program.
Meaning the government is buying.
Yes, we're talking about a nation-state using its massive treasury to secure long-term global resources.
Okay, that's huge.
Second, China recently approved a 41-unit nuclear construction pipeline.
41 new reactors.
Yeah.
So if you're a U.S. utility, you suddenly realize you aren't just bidding against, the power company in the next state over.
Yeah.
You're bidding against the sovereign checkbooks of the two most populous nations on Earth.
Exactly. And the third factor compresses the timeline even further, which is the January 2028 SWU deadline.
Okay, let's unpack SWU because that acronym gets thrown around a lot in the source material. It stands for Separative Work Units, right?
Right.
But how does an enrichment metric squeeze the mining supply?
Okay, think of it like a bakery.
I like bakeries.
The raw uranium pulled from the ground is the flour. But you can't just throw raw flour into a nuclear reactor. It needs to be processed and enriched,
Yeah.
basically baked into a cake to become usable fuel. So SWU measures the capacity of the enrichment facilities, the ovens. The January 2028 deadline relates to a severe bottleneck in global enrichment capacity. Because the ovens are going to be fully booked and operating at maximum capacity by 2028, utilities need to secure their raw flour years in advance just to guarantee they even get a spot in the enrichment line.
Oh, wow. So if you don't have the raw uranium in hand well before 2028, you literally miss your slot to get it enriched, which means you don't have fuel for 2030.
Precisely, which is why 11.3 million pounds are already spoken for at NextGen. Every pound contracted today is a pound those U.S. utilities won't have to bid on when India and China are sweeping the global market.
That makes total sense.
They are paying tomorrow's premium today because, honestly, securing a slightly lower price doesn't matter if you can't secure the fuel at all.
Right. What good is cheap fuel if your plant goes dark? So we have this incredible dichotomy. The extremes of current supply being trapped by bureaucratic delay and future supply being locked up out of sheer existential dread. Let's bring this back to the present moment, though, to the 48-hour window we're sitting in right now. How is the overall market digesting this news? I mean, the spot market finally broke its silence this week.
It did. For 4 consecutive weeks, the spot market was flatlined perfectly at 86 cents. Just a complete staring contest between buyers and sellers. But on Tuesday, we finally saw a directional move. It ticked up 40 cents to $86.90.
Okay, I have to play devil's advocate here. Is a 40-cent move on an $86 commodity really a big deal? It kind of just sounds like a rounding error.
I mean, in isolation, yeah, it is small. But in market structure terms, 4 weeks at exactly $86 meant the market had found a temporary, very fragile equilibrium.
Okay.
The 40-cent tick is the first crack in the dam. It shows that upward pressure is finally starting to build, driven by these earnings data points. The market now officially knows the domestic supply build is real, but the policy premium is delayed.
So it's the market basically waking up from a nap.
Yeah.
But here is the disconnect that really confused me when looking at the trading data.
What's that?
So despite the spot price ticking up, and despite these really strong operational updates from RNG and NextGen the shaft sinking contract for NextGen came in on budget, which eliminates a massive cost overrun fear. The stock market actually punished them.
Yeah, it was a weird reaction.
Right. Equity saw a classic sell the news dip. Energy was down 2.4%, NextGen was down 1.82%, Cameco down 2.1%. If the news is fundamentally solid, why are traders dumping the stocks?
Well, we have to separate the commodity from the casino.
Oh, I like that.
The stock market had already priced in the expectation of an immediate Section 232 policy windfall for Energy. Traders bought the stock hoping for a massive sudden jump in realized price. So when that $66.85 realized price printed, which just confirmed the policy delay, the short-term traders sold their positions.
Just cashing out.
Yeah. And for NextGen, the headline earnings beat was driven by a non-cash mark-to-market gain on convertible debt.
Let's explain mark-to-market gain really quick because it makes the earnings look artificially inflated. It's kind of like checking the Zillow estimate on your house, seeing the value went up by 50 grand, and then claiming your actual income increased this year.
That is exactly what it is.
Hmm.
It's just a paper profit based on current market valuations of their debt instruments, not actual cash generated from selling a product.
Gotcha.
So when institutional analysts strip away that paper gain, they're just looking at a mining project that is on budget and on schedule, which is great, but in the development stage of mining, simply being on budget confirms the long-term thesis. But it doesn't trigger the kind of explosive, unexpected surprise that causes a stock to gap up 10% in a day.
So the temporary sell-off is just impatient money leaving the room.
Exactly. The day traders leave, but the underlying long-term indicators are absolutely screaming that the structural deficit is getting worse.
Yeah, because the forward term price is currently sitting at $97 a pound.
Right. That $10 spread between today's spot price of $86.90 and the long-term price of $97 is the most critical metric on the board right now. Forward purchasing commitments are priced 12% above today's reality.
So the utility companies fundamentally believe, and they are betting billions of dollars, that uranium will be significantly more expensive tomorrow.
Yeah.
So what does this all mean for you listening right now? Why should you care about a 40-cent tick in a niche commodity or a delayed government document in Washington?
That's a fair question.
Right, because whether you're an investor looking at energy markets or just someone who relies on the power grid keeping your lights on and your air conditioning running, you are literally watching the blueprint of global energy security being redrawn in real time.
It touches everything.
It really does. This isn't just about rocks in the ground. It's about which countries will have the baseload power to run the artificial intelligence data centers and manufacturing hubs of the 2030s.
And that structural setup brings us to a really critical 48-hour window of catalysts that could break this whole consolidation phase wide open.
Okay, so Thursday is the big test. We have the U₃O₈ and TradeTech weekly spot print coming out.
Yes. We need to see if that 40-cent tick to $86.90 holds or expands. If the print solidly breaks above $87, it proves to the broader market that $86 was a floor, a foundational level of support rather than a ceiling.
It signals the end of the summer doldrums.
Exactly.
And hanging over all of this is the pending Section 232 Federal Register announcement. Now that Energy has put that $19.65 gap into the public earnings record, the pressure on policy officials in Washington is immense.
Oh, it's totally out in the open now.
Right. The data proves the miners are doing their job, the bureaucracy is lagging. The second that domestic content threshold is finally published, the legal loophole closes, and the math for U.S. producers changes instantly.
And simultaneously, the market is bracing for news on the NTPC India shortlist. Bids for that massive sovereign procurement program closed back in July.
So we're just waiting on the results.
Yeah. Right. We are now in the window where India will announce who made the cut. If a major Western uranium asset gets scooped up by a sovereign state, the available supply pool for U.S. utilities shrinks even further.
Which just exacerbates that existential panic we discussed earlier.
Exactly.
So we started today with a massive pricing puzzle. A booming U.S. uranium supply produced efficiently with low-impact ISR technology, but trapped by incomplete bureaucratic policy, forcing them to sell at a massive discount.
A painful discount.
And we juxtapose that against a desperate forward-buying spree where utilities are throwing billions at unbuilt Canadian mines just to guarantee they have fuel in 2030.
Because the market is violently caught between the bureaucratic delays of today and the sovereign supply fears of tomorrow.
And before we go, consider this final thought. Think about the incredible tension building up in this system. What happens to the global energy balance if the U.S. government finally finishes its paperwork, releases that Section 232 domestic threshold, and legally forces U.S. utilities to buy Americans in, at the exact same moment that India and China corner the rest of the available global supply?
It's the perfect storm.
Could we see a scenario where that $20 gap doesn't just close quietly, but violently flips the other way, creating a massive panicked bidding war for whatever uranium is left on the table?
I mean, when government policy finally catches up to physical reality, especially in a supply-constrained market, the repricing is rarely gentle.
No kidding.
The staring contest usually ends with a stampede.
And a stampede is exactly what the data seems to be pointing toward. We started by talking about the comforting, rational rules of supply and demand. But as we've seen, when you mix in legacy contracts, invisible government thresholds, the mechanics of enrichment deadlines, and the fear of a global scramble, the landscape gets incredibly complex. Thank you for joining us on this deep dive. Stay curious, keep questioning the data, and we will see you next time.